Hey everyone, happy weekend. Today is Saturday, July 25th. This is a market update. I've ducked into the office real quick to do an update. Thought I would wait till Saturday just to see what happened overnight on the U.S. Stock Exchange and the close of markets for the week. Very interesting week. Top three things to discuss today. First of all, inflation. Going to just revisit that story because certain things in the market are showing us that inflation is becoming or has become a concern. Second thing is the stock market. I've had some commentary from a few of you that, stocks just seem to keep going up, but I think, or I'll show you rather, some charts and some stuff to show you where there's a bit of a divergence between what's going on in the U.S. and what's going on around the rest of the world. And then finally, just want to reiterate the quad 3 call that we've got on at the moment in the quad 3 playbook. Made a couple of changes last night, get up at 5 a.m. Tuesday through Saturday to look at the final hour of trading in the markets and make any changes or additions to portfolios, that sort of thing, which I did last night. So I'll just quickly touch on those as well. First thing first, let's talk about inflation. So see if I can find some of these charts here that I wanted to show you. What we've got going on, particularly in gold, is clearly gold is hitting new highs. Not hitting new highs, sorry. It is ramping up. It's about to hit a new high, all-time high, that is. Back in 2011, 12, I think, is when gold last traded at its all-time high, around 1,923 US an ounce, something like that. And it did cross over the $1,900 an ounce mark this overnight, and it closed at 1,887 per ounce last night. So it's clearly trying to bump up into the 1900s, fighting a little bit around that level. One of the reasons that, and I'll just jump ahead to one of the things that I did sell last night, is I took down a little bit of the exposure to gold and the gold miners. I have not sold them completely. One of my jobs as your risk manager is to, when things go to the top end of their range, which is gold was continuing to do that, as was the GDX, the gold miners, is you want to try to take some profits off the table without taking down the entire core position. So what this is going to enable me to do, and if I just go back to this chart that I had up a second ago, what this should enable me to do, and in a second I'll see if I can find this other table I wanted to show you today as well around gold in particular, is that it'll give us the opportunity to buy it back at a lower price. And I'll explain that in a second. But final thing about inflation that I want to show you now. This is a chart here. I'm just going to make this bubble a little smaller. This is a chart here of U.S. inflation as predicted by my good friends at Hedgeye. Very mathematically driven process. This call is going has been very, very accurate over the past. I can't see any reason that that's going to change. The blue bars are what Hedgeye is calling for in terms of the actual inflation numbers. Now, we do know that the government can and does adjust their reporting of inflation numbers. However, even the Bloomberg consensus, which should be a consensus of a bunch of economists and other people out there in the universe who commentate on this stuff, showing inflation, which has dropped dramatically, clearly, but is ramping back up again. So the issue we have now is, because we're in quad 3, it's a very stagflationary environment. So for those of you who have been around long enough to have lived through a few economic cycles, the stag part of the inflation is no growth. So economy is shithouse, right? That's the problem with stagflation. The inflation part is we're getting inflation. So the cost of living is rising. And this is evident already in a number of things. Commodities have risen. Gold is signaling that inflation is upon us. And it's also signaling, I suppose, that the entire world is a bit of a shit show at the moment. So gold does get a safe haven bid. But certainly it's also very responsive to inflationary pressures. So anyway, other things like your I don't know if I've got a chart of the CRB in here. Probably not. I don't think I do. No, I don't. So anyway, I have shown you a chart of the CRB index, which has started to move higher as well, big time. And of course, gold is again one of the biggest measures of that. So that's the inflation story, and I think there's going to be more to come. That's going to drive more pain for the consumer. So again, it's going to be very interesting to watch both in the U.S., in Australia, and around the world. One of the causes of inflation is the fact that they are printing money with reckless abandon. The printing presses are running at full steam. The U.S. Fed, the European Central Bank, they're buying bonds, trying to manage the rate curve. They are buying now stocks. So the Japanese have been doing this. The U.S. has started doing this. And the Europeans, I think, have signaled that they're going to be doing this. They were in buying bonds all along, but whether or not now they're buying ETFs and so forth, I'm not sure. It wouldn't surprise me if they are. I know they talked about it about a month ago. Whether it's actually happening, I'm not sure. In any case, this is what they're trying to do in doing that, by the way, is they're trying to support the stock market, the asset markets, because this is something that people see. It's very visible, and it's something that I guess gives people confidence or gives them fear. If they see the stock market crashing, that drives more fear. They see the stock market rising, it's a sign of confidence. Even though most people, at least not in Australia, I suppose, because we have our superannuation accounts, so a lot of people are exposed to the stock market here in Australia. But in the U.S., most people are not exposed to the stock market. They don't invest in it. Really, this is about, I'm sad to say it, but it's really about the establishment being Washington and the U.S. Fed propping up their buddies on Wall Street. That's what this is about. It is sort of crony capitalism. Anyway, I've sort of segued into the stock market now, so let's talk more about the stock market and what is going on. So one of the things you guys know that I am constantly reminding you of is volatility. Volatility drives everything. I was having a beer last night with a great client of mine of the firm, and we were talking about the markets and so forth. He's really a student of the markets as much as I am, and I went through with him again the three-factor model, the high-level macro model that we look at in terms of the stock markets. Price, volume, and volatility. Those are the three sort of overarching forces that drive a lot of the stuff that goes on in the market. And volatility has, again, been one of those things that has been, I don't want to say all over the shop, but it's certainly, it's been a thing that has driven the market both up and down. So I want to highlight a couple of things. First of all, the VIX, as you can hopefully see here on the screen, the VIX has come back down below 26. Now, this is a big deal because 26 was kind of a line in the sand where above 26, it was still, very much a uninvestable market. You wanted to be very careful about what you did invest in. And now that it's dropped below 26, and it seems to be trending downward. So if I just pop this chart up, you'll lose the bubble here for a second, but just pop this chart on the screen, which hopefully, again, you're still seeing. You can see here, this is a daily, I think this is daily. Let's just double check here that this is a daily candle. If my mouse would give me that. There we go. Yep, daily candles. So as you can see, back in June, around June 8th or so, we started to see a big spike in volatility. I talked about it back at the time, spiked right back up into the 40s. And the market had a bit of a rough patch there, but then it's been trending lower, lower high, lower high, lower high. This is good. This is a good thing. We actually, despite the fact that, I keep warning you about the markets and I'm still, cautious about a number of things, the fact that volatility is falling is actually a good thing. We do want to see volatility falling, and it means then that I can allocate more capital to stocks, which is actually something that I've been doing recently because of the falling volatility. One of the other volatility measures I look at is the NASDAQ. Let's get the bubble back here. Is the NASDAQ. Now, the NASDAQ has had a different volatility measure, and really with the NASDAQ, we want to see the volatility under 33. So it's a different metric for the NASDAQ, which is the technology index. But again, as you can see, volatility there has been sort of persistently high above that 33. We'd have episodes of it dropping below. Curiously, the NASDAQ has continued to, hit all-time highs. That's driven largely off the back of about 5 stocks, being Facebook, Google, Amazon, Microsoft, and Apple. These stocks really do comprise a large component of technology stuff. They're leaders in that. If their momentum is going up, typically you see the NASDAQ also doing very well. Anyway, we've had the NASDAQ volatility sort of spike up this week and then come back down. And my point of saying all of this is that, again, volatility, well, you know the point. Volatility is a big deal. The final sort of volatility measure that I wanted to highlight for you is the gold volatility. Now, check this out. Gold volatility, gold, as you know, it's been, as I showed you from that chart, it's been going up, it'd sell off a little bit, going up, sell off a little bit. Gold is very much one of those asset classes that also responds to volatility. Again, I've said this before, I'll say it again just to repeat it. Assets flow to the things that have, or the asset classes that have, let me start that over. Cash flows to the asset classes that have falling or low or falling volatility. And they tend to move away from asset classes, or cash moves away from asset classes or assets that have rising or high volatility. So the fact that we've seen over time now the gold volatility coming down and the gold price rising is a function actually of two things. It's a function of volatility falling, but it's also a function of the US dollar falling. And I want to just quickly see if I can find this chart to show you. It's a correlation chart. It's something that I look at every single day. There we go. And what this is, it's a US dollar correlation, inverse correlation. What it's basically saying, it looks at time frames, 15, 30, 90 days. One of the reasons that we look at this is because, and you'll hear me refer to it as the machine. There's the big algorithmic machines that all the big investment houses and stuff use, and they've got it programmed on certain metrics and certain time frames that then mean that it's automatically placing trades, buys, sells, or what have you. And one of the correlations that we watch is gold and the US dollar. So what this negative 0.95 effectively means is that gold and the dollar now are becoming very correlated. So what's happening is the US dollar is falling. The reason it's a negative correlation because the US dollar is falling and the gold price is rising. And that negative 0.95 pretty much says that they're in lockstep with each other. So as the dollar continues to fall, gold continues to rise. Now, one of the other interesting metrics, I'll just see, yep, here we go. One of the other interesting metrics around this that I wanted to bring to your attention, and by the way, all this data you can find, reasonably easy, but obviously, I have it packaged up and delivered to me every single day, which makes it easy for me to talk to you about it because I can just reference stuff. But one of the things that, and I've shown this table before, it's the Commodity Futures Trading Commission position net long positioning. And this is a report that comes out once a week, and it's for historical data. So it's I think it comes out on Wednesday, and it's for the prior closing Friday or something along those lines, the positioning. And one of the things that we track or look at is, first of all, the net positioning. So are traders positive or negatively positioned? And these are non-commercial. So a commercial is sort of like imagine a Rio Tinto. They would be what's called a commercial. They are actually in the space of producing commodities, iron ore, etc. And they might sell futures contracts, which is what this is showing you, the futures contracts in all of these things down the left-hand side. But they would maybe sell futures contracts to ensure that they lock in a price for iron ore sales, as an example. But this table shows the non-commercials, which are basically all of the punters out there speculating in the market. And one of the reasons that we want to look at this data is because typically speculators, the punters, are wrong. Or what they do is they build up these positions, and they are usually at the maximum period where the position is at its largest relative to itself. They are actually wrong-footed, right? So I'll just highlight a couple things. You can see the red arrows. There's our little Aussie battler, which I'm not going to go into what a Z-score is, but basically that's the size of the position relative to itself over a 1-year period. And what that means effectively, a positive 2.64, means that it's 2.64 standard deviations away from what it has been over a year period. And typically when you get above, say, 2 times standard deviation, it means that you're at an extreme. Now, And when you get up to 2.5 plus, even up to, I don't know if I've ever seen any one of these things at 3 times. There probably has been a history of that. But anyway, you typically see them get up around 2 and go to 2.5 or thereabouts. What it means is that there are a lot of people betting on the continued rise of the Australian dollar. Now, again, typically these people are wrong at critical moments. The same could be shown here for the US dollar. There is a almost -2 time position where a majority of traders or speculators, if you will, are negative on the US dollar. And what happens in markets, right? A lot of this stuff is just maths, right? A lot of things, they mean revert. Now, if you don't know what that means in mathematical parlance, it means that there is a mean, there is a center line of something, and as price moves further and further away from that, the chances of it coming back to the mean increase. And so the further away you get, the further standard deviations away you get from the mean, I suppose the probability of that thing coming back to the mean, again, mean reversion, increase and begin to increase exponentially. And that's probably what this is really representing ultimately. Sorry, that's a little bit of a technical dive into this stuff, but it's very, very useful and informative, because I guess what I'm really saying to you right here is the US dollar has been exceptionally weak. It's had, I think, 5 weeks of going down. Now, that's a pretty unusual thing for any market to go, down for an extended period of time or up for an extended period of time without some sort of counter trend correction. So ultimately, I guess what I'm saying here is I'm expecting to see the US dollar bounce. And what that bounce looks like, I don't know. Will it, relative to the Aussie, will it go from, 70 cents? Will the Aussie go down to, 68, 67, 65? I don't know. I really don't know. There would have to be some sort of driver to drive people back to the US dollar. And in quad 3, the US dollar does not perform particularly well. In fact, the only quad that the US dollar really does well in is quad 4, which we're definitely not in at the moment. We are in quad 3. So anyway, again, sorry for the sort of pausing on this, but it is kind of useful to understand these relationships and ultimately drives the decisions as to why I'm doing something. So let me just explain why I'm doing something. Because the US dollar has been so weak, and the correlation, if I can get that table back, where did it go? The correlation between the dollar and gold is, 0.95 might as well be, 1. It never goes 1 to 1, but anyway, it could go up to 0.96, 0.97, 0.98. Anyway, it might as well be, 1 to 1. So my expectation is that we have reached, probably for this particular time point or rally in gold in particular, and the sell-off in the US dollar, we've probably reached a point of maximum divergence. And those two things should come back together again. We'll see. I don't know if that, I can't say for absolute certainty that that's going to happen, but the odds are that it will. And if you look back at a chart of gold, I'll just see, that's earnings, which I'm going to go through in a second. If you look back at that chart of gold, as you can see, that's what happens. You go up. Of course, we don't have the US dollar on this, but it would be a function of that. It goes up, comes back down a bit, goes up, comes back down a bit, goes up, comes back down, goes up, and this is where we are right here, goes up. What sort of correction will we get? Don't know. But I'll be watching those metrics to guide me when to put back on some of the gold, some of the profits that I just took in gold and the gold miners. And remember, GDX, which is the gold miners, we have the MNRS in Australia. These things are equities. So if we start to see, and the other thing on that correlation table is also the equity market, the S&P, it has a pretty high correlation to the dollar as well over a short period of time, over a 15-day period. And so, again, what can happen is if the US dollar starts to rally a little bit, we'll probably, again, see the S&P 500 and the stock market in general begin to sell off. So anyway, there's a little bit of a some insight into the stuff that I look at and do every single day and how I get some decisions made. Now, finally, quad 3, recession. We are still absolutely in the throes of a recession. There's no doubt about that. I think I've got these articles open. Let me just see if I have it. Yep, I do. So, if you're watching some of the articles that are being put out there, it's quite clear that the Australian government is very cognizant of the fact, first of all, that the RBA in Australia has no more ammunition, really. The RBA even came out and said that. I told you this a few probably months ago, where the RBA, they cut rates down to 25 basis points, and they said to the government, well, we're kind of done. Like we've done everything we can from a monetary policy point of view. It's time for you guys to now step in with fiscal policy responses. And the government here has responded and done that. And they've done, I think, a pretty good job of doing that. So luckily, our national balance sheet has been really strong. We are nowhere near being in the position the U.S. is in terms of our debt to GDP ratio, at least from a government debt point of view, and not having the capability to fiscally spend and go and deficit spend and try to help the economy out. Now, the problem is, and I put an article in the boardroom over the week, I think on maybe Tuesday or Wednesday, about the fact that JobKeeper has created or is creating zombie companies or zombie employment and I don't understand exactly how this works because it blows the mind that someone could make more money being on JobKeeper than they would being at their job. So there's something wrong there. And I think the government's figured that out. I did read something where they were going to extend JobKeeper, but they're going to tighten up how you qualify for it or the benefits you get, which is good because otherwise we're basically going to be paying people not to go to work forever. I mean, this is insane, right? It's socialism 101. It's just ridiculous. And I actually was talking with this client last night about whether this was some weird end run around how to get a universal income. You can look that up, universal, I think they call it universal something income. I'm trying to think of the middle term there. But anyway, it's this idea, I think it's come out of Norway or one of those massively socialist countries where everyone should get paid a base level of income just by the government. So everyone should have, I guess, a living wage, whether they're working or not. It's called universal income. And I think this is ridiculously socialist, and it just goes against everything that I've ever been taught or brought up to know, which is you work hard. You get an education or a trade or whatever it is you do. You go to work and you work to earn a living, and you shouldn't expect the government to look after you. And unfortunately, 150 years ago, we didn't have government being able to do that, so people had to work hard and built up these resiliences and these mindsets. If you look back to the Great Depression era, so my grandparents and for some of you watching this, your parents, they had a real, pull yourself up by your bootstrap, get out there, work hard, make a living, save money, invest it, and because no one's going to look after you. To today, where we've got all of these governments around the world, and it's everywhere. All you have to do is look at it. Europe, massively socialist. The U.S. headed that way. They're already really there as a real state. They say they're the bastion of capitalism, but the reality is exceptionally socialist. And here we are in Australia too. We're pretty much down that socialist vein anyway. We do have a lot of the signposts of capitalism in this country for sure, but there's a lot of socialism here too. And so JobKeeper, I guess really what I'm saying here is JobKeeper is one of those things that need to be really managed carefully and withdrawn when it looks like the economy is getting back to recovery. So look, I'm not a big fan of a lot of those things. Yes, we are again in a recessionary period. And sorry, let me just touch on a couple of quick things before I continue my rant and then wrap this up because I got a baseball game to go play in about 2 hours. I just wanted to hit earnings because I know I've been talking about that. So I want to give you a bit of an update on that. So this is from July 22nd. That's the earnings table. We had 61 companies reporting. Earnings were looking, still pretty bad overall. But they've come back a little bit. As we get more companies reporting, you're seeing the earnings growth and sales growth figures. I'll just toggle back. Sales growth minus 6.46, minus 20 on the earnings. They're sort of coming in a little bit, and we're now up to about, I guess, about a quarter, let's say, of the S&P 500 reporting. But earnings are still looking pretty shit. And I don't think that number there is going to get much better, but again, we'll see. We still have a number of companies to report. Obviously, another 380 companies to report roughly. So that's still a lot, and we'll get more reporting next week, and I'll touch on this again next week. But again, the reality is that earnings growth has been bad. And companies this week that have reported, many of them have reported, I mean, even Apple, has reported poor earnings. Microsoft has reported poor earnings. These are massive companies. And we're going to continue to see that, I dare say. We're going to continue to see that maybe for another quarter, even after this one. So the point of me talking about the growth in earnings is that probably, I don't know, a month or 2 months ago, I showed you a chart of the workout period or the time frame when you get a recession, the time frame that you're in that recession, in that recovery period. And the best circumstance we've ever had over the last 100 odd years is a 7-month sort of recovery period. And I don't think this is a garden variety or even this is not even a mild recession. This is going to be deep economic carnage happening. So we will have a continued workout period. And as such, again, I'm not expecting these earnings to get much better anytime soon. On that point as well, I was watching a commentary about the travel and entertainment industry in the U.S. and around the world. And again, clearly, we're going to be having problems with the reopening of casinos, the reopening of restaurants, the reopening of people traveling and going and doing things. So there's probably, we've been in this sort of honeymoon. That's a bad word to use. We've been in a quad 1 and 2 scenario where we've gone into the deep economic depression, which was the last couple of months. We've come out of that as the economy has reopened around the world. We're starting to see the COVID cases increasing again, which is interesting, of course. And so what happens next is, I don't know. What happens next is, or what we're seeing happen next, at least in Australia, is the isolation and shutdown of areas where there's been outbreaks. Now, if we see that starts to creep a bit more nationally or in a state, if it starts to get more serious and spreading, we could very well see states go back into a lockdown, or possibly, the entire country go back into some sort of lockdown. So this is a big concern. We are nowhere near being out of the woods yet. So I suppose the final point I'll make, and I touched on it a moment ago, is sort of the stock market. And I want to actually just quickly cover where we're at with some of our economies. So this week I've sold some gold. I've just sold some gold, and I have bought some China, which is going into quad 1. They're in quad 1 now. They're going to be in quad 1 hopefully for at least the next 3 or 4 quarters. That's good. So China is a buy. Some emerging markets, Thailand, Indonesia are a buy at the moment. I've got some Thailand on. I think we might have seen Indonesia be put on as well. I have to go look and see if the order got filled. But in any case, I'm putting some cash to work in economies and areas that are going into the economic quadrant that is conducive to growth. And so again, those aforementioned places are exactly that. And I'm starting to pick some individual stocks that should do quite well going forward. So groceries, there's a couple positions in there on groceries. So Albertsons, which is a big national grocery chain in the U.S., and Sprouts Farmers Markets. And I'm going to be looking to put on another small position in a company called Nomad Foods, which is a European-based company. And there was another thing I forget. But in any case, we are very much managing a quad 3 overall portfolio, but looking for spots to sort of begin building positions and stuff that'll do well in a quad 1 and 2 scenario. And of course, managing around some of these other core positions like gold, the tips, the inflation protected tips. And I think that's about it. So guys, thank you very much for all the commentary and support. I really appreciate it. I think these videos certainly give you the ability to see what's going on in my business and how I analyze markets and what I do to take decisions. And always feel free, please, to contact me with any questions or any comments that you might have. And of course, as a reminder, in the boardroom pinned at the top of the Facebook page, if you want to make an appointment to have a chat with me. I'm going to have JJ put in a couple of different appointment options. If it's just a quick call, you can do a 15-minute. And then if it's something a bit more substantial, like we need 30 or 45 minutes or an hour or something like that, you'll be able to choose some other time frame. So that's done through a program called Calendly. It links into my calendar. You can jump in there, book yourself in. So please avail yourself of the opportunity to do that. Calling me to book an appointment probably is not the most efficient way to do that. So because you can see my calendar, unless there's some problem with the calendar where the appointment shouldn't have been made, we'll contact you. Otherwise, we'll just see you on the appointment. Have a great weekend. Hope everyone is safe and well, and looking forward to the end of winter. Let's hope we don't get battered too badly tonight with this supposed massive rain and whatever we're going to get. And I will update you again next week on what's going on out there. Take care and have a good weekend. See you. Bye-bye.